Welcome back to the Talking Hedge. I'm Josh Kincaid, Capital Markets Analyst and host of your Cannabis Business Podcast. Today, we're going to do an article about gold, counterculture, if you will. In the past, we've talked about how cannabis and vice stocks or sin stocks have an inverse relationship to the overall market. Today, we're going to dive into gold and what that might do in the long term, being kind of countercultural. A lot of people are saying that it's just a shiny piece of metal that you dig out of the ground and put back into a safe. That's kind of famous words from our friend over at Berkshire Hathaway. Of course, we're talking about Warren Buffett. So the FDIC urges Americans to keep their money in the banks. It's safe. So yesterday, the chair of the FDIC released an astonishing video asking Americans to keep their money in the bank. That comes from FDIC Chairman Jelena McWilliams. She said that, quote, "Your money is safe in the banks. The last thing you should do is be pulling your money out of the banks thinking that it's going to be safer somewhere else." So this same thing happened back in 2008. Millions of people across the country stopped paying their mortgage and the banking system nearly collapsed as a result. There's a lot of people that are going to have to stop paying their mortgage and credit cards, auto loans, directly impacting the financial institutions, banks, specifically credit unions. So many are operating with the even smaller safety net. The median restaurants, for example, had a cash balance of just 16 days. So this pandemic could easily push several big companies into bankruptcy, and that's just what we're seeing right now. So being ridiculous that the FDIC only has $109 billion to insure the entire $13 trillion banking system, that's less than 1%. Fractional reserve lending, of course, is when the banks get $1 and then just multiply that tenfold so that they can start, lending that out. And that's exactly what rehypothecation is. Difference between physical gold and paper gold is rehypothecation, meaning multiple people own that paper. So if you think that you can just get the commodity owning an ETF, that's not the case. And in fact, we're seeing some companies completely get away from that entirely. The Chicago Mercantile Exchange is going to change the way it delivers physical gold amid a complete breakdown, and we'll get there eventually. There's ABN AMRO. They've completely gotten away from this because they know that there's no underlying gold. They can't deliver when people want to convert their paper, their stock, their ETF, whatever. So they're completely getting out of the game in order to avoid lawsuits and anything else. They're going to be the first ones to do it. Banks have never had to deal with what we're going through right now. So neither the FDIC nor any banks have never had to deal with the complete shutdown of the economy and potential losses of this magnitude. This is fear-based first. We're going to have an economic recession. We're going to have social unrest. We're going to have financial breakdowns. Everything we have right now is just fear-based from the epidemic. We don't have any fundamentals or any real economic issues. The supply chain disruption hasn't even impacted businesses yet. And so this is really just the beginning. So they're casually brushing off the risk, claiming that everything is 100% safe. Kind of seems incomprehensible coming from the FDIC. So not suggesting that you take your entire life savings in cash, but having a month or two probably wouldn't hurt. And then from my perspective, when the FDIC specifically says you shouldn't do something, it's probably prudent for you to really look what's going on. Do your own due diligence. Look for yourself. All I'm saying is the federal government tells you that it's safe. It's probably not. Case in point, there's a gold bullion shortage, worse than it has been in 45 years. So the U.S. Mint completely sold out of double eagle silver and gold coins. So's the Canadian Mint. The Swiss Mint has completely stopped due to a corona, or that's their reasoning anyways. They probably don't have as much bullion to make the gold that they want to. And a lot of that actually came out of Latin America. So they didn't really care. There's a pretty good documentary out there that you guys can check out on Netflix that kind of dives into the dirty money as it pertains to gold. If I remember, I'll leave a link in the show notes for that. But essentially, a lot of the miners have stopped production because of COVID and lack of supply, although they're not talking about that, because once you start talking about a shortage in supply, demand goes up, and there's already a bunch of demand from central bankers to governments to the elite worldwide. They're gobbling this up, and that's That's when silver has been the lowest in about 5,000 years. When you look at the silver to gold ratio, gold has gone up, silver has not. And that disconnect hasn't been wider now than it has been in the last 5,000 years. So when silver hit $11 last week, that is incredibly cheap. I think it hit $50, 2 decades ago, but it probably will catch up. Meaning silver will probably be about $500 shortly if if anybody goes back to the gold standard or even partially gold backed. Gold recently saw a surge of 6% on a lot of the shortage and massive demands. Some of the news headings include gold up 6%, biggest climb in 11 years amid tight supplies and limitless monetary stimulus, gold facing a historic squeeze, stocks and gold surge on new stimulus from the feds. Goldman Sachs says it's time to buy gold, the currency of last resort, and the Chicago Mercantile Exchange is asking to change gold delivery rules amid coronavirus lockdown. The London Bullion Mercantile Association acknowledged that gold liquidity problems amid a price volatility. Dutch bank ABN AMRO is closing customer gold accounts. That's a big one right there, because most people don't know that if you own paper, you don't own physical. If it's not physical, it's not real. So the fact that ABN AMRO is closing all customer gold accounts is big news. It's telling people in the marketplace that if you own paper, you don't own it. And so again, rehypothecation is when you own a stock, or you think you do, but really that's only in street name. So the person who owns it is the broker, and the broker is also letting somebody short that. So there's two owners. There's the person who's going long and the person who's shorting it. So rehypothecation allows for the selling of that stock to short it. And so when you have all of these derivatives, it means that nobody really truly owns that. So they're just closing out all of these accounts because they can't give people the underlying commodity, in this case being gold. So they're just closing out the accounts entirely. So what we're seeing is a gold market breakdown. Their gold spreads are exploding as the London bullion market is having liquidity issues. Last night, they observed the unprecedented gold run on precious metal dealers, which has left the gold vendors with little to no physical gold. There's a spot price you're going to see, 1650 or whatever it is. But if you go out to a coin dealer, they're going to be asking 18,000 or 2,000, whatever. Silver prices, $20 to $30 per ounce. And that's if you can find it. That's just for right now. And until more people gobble this up, it's going to become even more difficult. And at some point, it's not even going to become affordable, even if you can find it. So the head of commodity strategy at Saxo Bank said this has caused a breakdown in the marketplace. There's no price discovery in the market right now, he said on Tuesday morning. And if you need to borrow gold for the over-the-counter markets right now, you're going to pay a king's ransom. So the CME of the Chicago Mercantile Exchange is urged to change the physical gold delivery rules amid the market breakdown. So the surge in demand for physical gold that results in precious metal vendors and exchanges become sold out in a very short notice has created shortages in some geographical locations that's stressing gold markets drastically, and decoupling has become extreme. That is from paper to physical gold prices, with a frenzy of buying the yellow metal, with consumers rushing for toilet paper rolls. Some traders are cashing in their dollars for gold, saying that the paper currency probably won't be worth anything but toilet paper. There's traders that are fearing a shutdown of air travel and precious metal refineries due to coronavirus outbreak, making it harder to ship the bullion from London to the U.S. to meet the contractual obligations. So the LBMA, or the London Bullion Market Association, several major other banks that trade gold, the CME Group, they all reportedly changed its contract delivery rules to allow gold bars in London to be used to settle its contracts to ease disruption in trading. No matter what, regardless if they approve it or not, there's a serious crack starting to appear in the paper markets as the world reaches for money. The Fed explicitly admits to infinite dollar debasement capabilities, making that gold even more valuable. There's been a lot of political risk around using gold. The U.S. hasn't really allowed for it. Saddam Hussein wanted to sell oil for euros, and he was murdered. And you've got Muammar Gaddafi, who wanted to use a gold-backed dinar, an African-based currency. He was eventually murdered for that. Surprisingly, Maduro in Venezuela, the U.S. wants to extradite him on drug charges and completely tried to ruin the economy there. China, interestingly enough, has been able to create a third oil platform. So, in addition to Texas's, um, they have crude and Brent in Texas and in London. There's a third market now in China, and it's going to be backed by gold. So, they have an enormous amount of oil reserves and gold in China. And so, the fact that China has been able to get this far is farther than anybody has been able to get in my lifetime. And so, if or when that marketplace goes online, it's going to take a lot of money away from the traditional financial world of London and New York. And I think that China is going to be that third party, that new market that's going to have gold backed currency. Uh, Gold back oil reserves, and so that Silk Road that they're creating is actually going to have a lot more foundation. There's going to be more people that trust in that market because it's backed not by the full faith and credit of the government, because that's what the U.S. dollar is backed by, is full faith and credit of the U.S. government. So when there is no faith and credit is debt, they're going to look for the next cleanest shirt in the room, and that's going to be China, I think, with the amount of reserves that they have and the cheap labor. Everything is probably going to be shifted over there in terms of a global power, just from based on what I've seen. But if you do have an opportunity to pick up some gold and silver, that's what I would advise. Rumors have it that you can get 500 ounces of silver, and when the shit hits the fan and housing dips, that you can trade 500 ounces of silver for the average home. That's going to require housing to drop 85%, which, if based on numbers and averages in some areas in North America, you're going to see housing prices drop 85% in some regions. That's as serious devaluation and deflation occurs before hyperinflation. So before the dollar is completely worthless and not a world currency anymore, you're going to see everything go down, almost everything. Vice stocks may still go up. Obviously, gold and silver, precious metals will go up. And then eventually anything that isn't tangible will crash. So eventually it'll be art and housing and gold and silver. Those things will all be worth something because it's tangible. But for the paper markets, I think that's going to implode as with the new world currency. It might be a special drawing right. The SDR is a basket of currencies globally. And so Jim Rickards kind of talks about that. He's a political strategist. Mike Maloney with goldandsilver.com talks about precious metals. So there's a lot of talk out there about what people are going to do. Ultimately, you got to do what's right for you. If you can afford to hedge against the US dollar, I'm going to buy some Canadian currency, physical currency, as it's about 40 or 50% less than the US right now. I think it's trading at 140 Canadian dollars. So that's a decent play if everything goes back to normal, which I'm not expecting. But it'll just kind of help with that currency exchange being so close here in Seattle. I would advise stocking up on silver and gold, just with the eventuality that they're going to be running out and more governments look to repatriate their gold. So look that up. There's a lot of countries that are repatriating their gold, taking it back because they don't trust it being in the Federal Reserve, being held in the US. Since World War II, a lot of countries in Europe put their gold in Fort Knox, if you will, for the US to protect it, and no longer. They just don't trust us. They want their own gold back. And that's really kind of a strong message about security and risk and the future of what may be going back to a gold-backed standard. But only time will tell. So with that, we're going to roll this one up. I'm Josh Kincaid. This is the Talking Hedge. Don't forget to like, share, and subscribe, or don't. And I'm out.